Talking first about income categories, how does the IRS treat the associated tax treatments with active income versus portfolio income versus passive income?
So they're all individualized. So when you think of an active income is something that you actually materially participate in. So think of, you have a job, you get wages. That's something you actively participate in. You're a real estate agent, you sell properties, you're active in that sale, you get a commission. Active income is ordinary income, so it's taxed at ordinary income tax rates, but it's also subject to self-employment tax. So that's FICA and Medicare. So that's the difference with active income. Active income is taxed at ordinary income rates. It's subject to self-employment tax, either through wages, withholding there, or self-employment tax when you file your own tax return. Portfolio income is preferential. Portfolio income, when you think of that, you think of capital gains. That's the largest chunk of a portfolio income, and it's taxed at its own tax rate. So if you've got long-term capital gains rates, it's taxed at 20%. If it's a bullion or something of that nature, it might be taxed at 25%, but it has its own tax rate. And then the last is passive. Passive is also ordinary income. It's taxed at ordinary income tax rates, but it is not subject to self-employment tax because you are passive or you don't materially participate in that activity. So those are the three kind of buckets of income. The one thing to remember with those three individualized buckets is they really only can be offset by income or losses within that bucket. So capital losses can only offset capital gains. Passive losses can only offset passive gains. So active income can be offset by active losses, but active losses can actually offset every other income category that's out there. So that's the one big thing, and that's why when you talk to a lot of people, they're always chasing active losses, being a real estate professional or something of that nature, because it can offset any other income.
And what would be an example of an active loss?
You operate a business and it's capital intensive business. So you buy a lot of equipment and you depreciate that equipment and have a loss. Or you're a real estate professional and you buy a piece of property that has a large loss through depreciation.
So if you're buying something for the business that you can write off, that would be active losses.
Correct.
Got it. And that will offset your active income.
It will offset active income, it will offset portfolio income, and it will offset passive income. That is, when you think about the three different buckets, I tend to call it a waterfall, and active income is the top of the waterfall. And so once it's offset all the active income, it falls down to the next level and then the next level. And so passive income is the bottom. That bucket is the bottom of the waterfall. And so passive losses offset passive income, but since they're at the bottom, they can't offset anything else. They just carry over to the next year.
Got it. So another kind of perspective, let's say I have a job. I have W-2 income and I invest in real estate passively. Is there a way for me to offset my active income with the real estate investment, or is that not going to fly?
If you have a wife or a spouse that is a real estate professional, yes, but you personally typically cannot do that if you're a full-time employee, because you have to do real estate more than your active job.
If she is a real estate professional and she qualifies and you're married, now you can qualify for passive losses.
You can take that passive loss and convert it to an active loss.
Okay.
Because she's active in real estate.